as expected, then another interest rate rise, the 10th in a row. Bear in mind, this is what's been going on all around the world. The US Federal Reserve last night raised its main policy rate, Fed funds, albeit by a quarter point. The European Central Bank, in around 3/4 of an hour's time, is expected to confirm that it's raising its main policy rate by 0.5% as well. So that is really what is expected here. As I say, what we want to do is find out the composition of the vote. I'll see if I can get any information on that while we go through it. Nothing on the screens as yet. But really, no surprise there. In terms of, I'm trying to look at, there's still no word on the composition yet. Maybe someone can find that out. Obviously, the Bank of England was facing something of a dilemma here, because all of the background mood music to the economy is not great. If you look, for example, at manufacturing activity, with the latest Purchasing Managers Index survey data, all pointing to a slowdown there in manufacturing. And there's a lot of talk of recession in the air, and that is something that the bank will be really, really cognisant of. They don't want to overdo it in terms of tightening monetary policy in case they make a possible recession worse. Remember, of course, that the UK did not go into recession at the end of last year, as had been widely expected, including by the Bank of England itself. That was their central forecast as well. I'm just trying to see if we do have any update.
Yeah, and Ian, I'm just reading here that the Bank of England's 9 interest rate setters voted 7-2 to increase the bank rate to 4%. I don't have details of what the other 2 voted for at present, but no doubt you will find that information. That
is very interesting, Anna. I mean, that confirms basically that the doves remain doves. I suspect it will be the same 2 individuals who voted in favour of maintaining interest rates where they were last time around. That's Shriti Dhingra and Silvana Tenreiro. I'm just reading the MPC statement now, Anna. The key point they make is that global consumer price inflation remains high, though it's likely to have peaked across many advanced economies, including in the UK. So that's a warning that notice from the bank that they do expect rates to come down. They're talking about wholesale gas prices here. But here's the key point, I think, here, Anna. UK domestic inflationary pressures have been firmer than expected. Both private sector regular pay growth and services PMI inflation have been notably higher than forecast in the November monetary policy report. The labour market remains tight by historical standards, although it started to loosen, and some survey indicators of wage growth have eased. So the bank making the point there, really it's these high levels of wage inflation that they're starting to see creeping through, which means that they had very little choice to raise interest rates right now. And again, I'm looking at the concluding remarks here around the policy statement. It's all about the fact that inflationary pressures here in the UK have been firmer than expected, and the MPC cognisant of the fact that CPI, the headline rate of inflation, currently more than 5 times higher than the bank's target rate. Here's the composition then. It was indeed Swati Dhingra and Silvano Tenreiro. They preferred to maintain interest rates, bank rate at 3.5%. So really no change in the balance between the doves and the hawks there on the Monetary Policy Committee. And here's the forward-looking bit that I think the market will be most interested in. The line here, looking further ahead, the MPC would adjust bank rate as necessary to return inflation to the 2% target sustainably in the medium term. And again, another kicker here, the extent to which domestic inflationary pressures ease will depend on the evolution of the economy, including the impact of the significant increases in bank rates so far. There were considerable uncertainties around the outlook. The MPC will continue to monitor closely indications of persistent inflationary pressures, including the tightness of labour market conditions and the behaviour of wage growth and services inflation. And here's the key line, I think, that everyone's going to hang their hat on today. If there were to be evidence of more persistent pressures, then further tightening in monetary policy would be required. So interest rates, bank rate at 4% right now. As I said just before we got that decision, the markets are pricing in right now bank rate to peak at around 4.8%. Well, the Monetary Policy Committee there in those minutes making very, very clear that there are likely to be further interest rate rises to come. We are not at what market participants yet refer to as the terminal rate. There will be further interest rate rises to come if these sort of levels of inflation remain persistent. Now, bear in mind that inflation expectations the expectations around inflation is that it will peak around mid-year and then start to come, or it's already peaked in October last year, but we expect it to start to tail off quite rapidly come the middle of the year as you reach annualised effects of the commodity price inflation increases that we saw last year.